Enron. The name once signified innovation, ambition, and boundless potential. From humble beginnings as a natural gas pipeline company in Texas, Enron transformed itself into an energy giant. It was a darling of Wall Street, lauded for its pioneering use of complex financial instruments and visionary leadership. The company's stock soared, making millionaires out of employees and enriching its executives beyond their wildest dreams. Enron seemed unstoppable, a shining example of American ingenuity in the burgeoning energy sector. Its success story, however, was built on a foundation of deceit and manipulation, a house of cards destined to collapse. Enron's early success was fueled by deregulation in the energy industry, which allowed the company to trade natural gas and other energy commodities like never before. It created a vast network of pipelines and trading platforms, connecting buyers and sellers across the globe. Enron's traders became masters of their universe, using sophisticated algorithms and market analysis to exploit price discrepancies and generate enormous profits. The company's innovative approach to energy trading revolutionized the industry. It propelled Enron to the forefront of the new economy, a world where technology and globalization were blurring traditional boundaries and creating unprecedented wealth. Yet, beneath the surface of this corporate success story, a darker truth was brewing. Enron's meteoric rise was fueled not just by innovation but also by a dangerous cocktail of greed, ambition, and a willingness to bend and ultimately break the rules. The company's executives, blinded by their own hubris and driven by an insatiable thirst for profit, began to engage in accounting practices that were questionable at best and downright fraudulent at worst. The stage was set for one of the most notorious corporate scandals in American history. At the helm of Enron's rise and fall were two charismatic and ambitious figures, CEO Jeffrey Skilling and Chairman Kenneth Lay. Skilling, a brilliant but ruthless former McKinsey consultant, joined Enron in 1990 and quickly rose through the ranks. He was the architect of Enron's energy trading strategy, transforming the company from a traditional pipeline operator into a Wall Street powerhouse. Skilling's vision was grand, to create the world's leading energy company, a company that would transcend traditional industry boundaries and redefine how energy was bought and sold. Lay, a friend and mentor to Skilling, was a respected figure in the energy industry and a close confidant of President George W. Bush. He provided the political connections and gravitas that Skilling lacked, using his influence to lobby for deregulation and promote Enron's interests in Washington. Together, Skilling and Lay formed a formidable partnership, driving Enron's growth and fostering a culture of risk-taking and ambition within the company. They preached the gospel of the new economy, a world where traditional accounting rules were seen as outdated and where innovation and entrepreneurial spirit were paramount. Under Skilling's leadership, Enron embraced a philosophy of mark-to-market accounting, a controversial practice that allowed the company to book future profits on long-term contracts as current income. This practice, while legal at the time, gave Enron enormous leeway in manipulating its earnings and creating the illusion of profitability. The company's true financial picture, however, was far less rosy. Many of Enron's ambitious projects were losing money, but these losses were carefully concealed through a complex web of off-balance sheet entities and accounting gimmickry. Mark-to-market accounting, once an obscure accounting method, became Enron's weapon of choice in its quest for financial dominance. This practice, while legal under certain circumstances, allowed Enron to book potential future profits as current income, even if those profits were highly speculative and based on complex financial models. In essence, Enron was allowed to value its assets based on what it believed they would be worth in the future, rather than their actual present value. This practice gave Enron tremendous flexibility in manipulating its earnings, creating the illusion of consistent profitability even as the company was hemorrhaging cash in many of its core businesses. For example, Enron could sign a long-term contract to supply energy at a fixed price and then immediately book the projected profits from that contract, even if the energy was not scheduled to be delivered for years to come. This practice allowed Enron to inflate its earnings and impress Wall Street analysts who were wowed by the company's seemingly unstoppable growth. However, mark-to-market accounting was a double-edged sword. While it allowed Enron to inflate its profits during good times, it also magnified its losses when the market turned sour. If the actual future earnings fell short of the initial projections, Enron was required to restate its earnings, leading to a devastating impact on its stock price. This vulnerability, coupled with the company's increasingly aggressive use of off-balance sheet entities to conceal its true debt levels, set the stage for Enron's spectacular downfall. As Enron's star continued to rise, cracks began to appear in its carefully constructed facade. Whispers of accounting irregularities and concerns about the sustainability of Enron's business model began to circulate among industry analysts and financial journalists. Some questioned the company's complex financial dealings and its reliance on mark-to-market accounting, warning that Enron's earnings might be too good to be true. These early warnings, however, were largely ignored or dismissed by a market enamored with Enron's growth story. The company's executives, confident in their ability to manage the narrative, brushed aside the skeptics and assured investors that Enron was on solid ground. Inside Enron, however, a different story was beginning to emerge. Some employees, troubled by what they were seeing, began to voice their concerns about the company's accounting practices and its increasingly risky business ventures. These internal whistleblowers, often motivated by a sense of duty and a desire to prevent the company from going down a dangerous path, played a crucial role in ultimately exposing Enron's fraud. They risked their careers and reputations to shed light on the company's wrongdoing, providing crucial information to journalists and investigators who would later bring Enron's house of cards crashing down. When Enron's house of cards finally came crashing down, the aftermath was nothing short of catastrophic. The company's collapse sent shockwaves through the financial world, leaving employees, shareholders, and the broader economy reeling from the impact. Thousands of employees lost their jobs and retirement savings while investors saw their investments evaporate overnight. The legal repercussions for Enron's key players were severe. CEO Jeffrey Skilling and Chairman Kenneth Lay faced intense scrutiny and were eventually convicted of fraud and conspiracy. Skilling received a lengthy prison sentence, while Lay passed away before serving his time. CFO Andrew Fastow, the architect of many of Enron's deceptive financial practices, also faced significant legal consequences, receiving a reduced sentence in exchange for his cooperation with investigators. The scandal prompted a complete overhaul of corporate governance and accounting regulations. The Sarbanes-Oxley Act, enacted in 2002, introduced stringent reforms aimed at increasing transparency and accountability in corporate financial reporting. The act mandated stricter internal controls, greater oversight of auditors, and harsher penalties for corporate fraud. The Enron debacle served as a cautionary tale, highlighting the dangers of unchecked corporate greed and the importance of ethical leadership. It underscored the need for vigilant regulatory oversight and robust whistleblower protections to prevent similar corporate malfeasance in the future. While the fallout from Enron's collapse was devastating, it also paved the way for significant reforms that continue to shape the business landscape today. The Enron scandal stands as one of the most notorious examples of corporate fraud in history, but its legacy extends far beyond the courtroom and the prison sentences. It serves as a stark reminder of the catastrophic consequences of unchecked corporate greed and ethical lapses. In the years following Enron's collapse, the corporate world underwent a transformation. The Sarbanes-Oxley Act of 2002 was a direct response to the scandal, introducing rigorous reforms designed to enhance corporate transparency and accountability. Companies were now required to implement stricter internal controls, and auditors faced greater scrutiny to ensure the accuracy of financial reporting. But beyond regulatory changes, the Enron debacle also sparked a cultural shift within the business community. It highlighted the critical importance of ethical leadership and the need for a strong moral compass in guiding corporate decisions. Business schools began incorporating case studies of Enron into their curricula, using it as a cautionary tale to educate future leaders on the perils of ethical compromise. The scandal also underscored the vital role of whistleblowers in safeguarding corporate integrity. Sharon Watkins, Enron's vice president, bravely voiced her concerns about the company's accounting practices, and her actions played a pivotal role in exposing the fraud. Her story inspired stronger whistleblower protections, ensuring that those who speak out against corporate misconduct are shielded from retaliation. As we reflect on the legacy of Enron, we are reminded that the pursuit of profit must never come at the expense of ethical principles. The lessons learned from Enron continue to resonate, serving as a powerful deterrent against corporate malfeasance and reinforcing the importance of integrity in the business world. While the scars of Enron's collapse remain, its impact has been a catalyst for positive change, shaping a more vigilant and ethically conscious corporate landscape. The story of Enron is a testament to the enduring power of accountability and the unyielding pursuit of justice.